Hello and welcome to Market Domination. I'm Josh Lipton alongside Josh Schaefer, live from our NYC headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
With Microsoft, their Azure business, I think you'll see good growth there. I think with Amazon Web Services, you'll also see healthy growth there. And I'll also highlight the Google Cloud business, which we think is an underappreciated opportunity for them. And so I think that will remain healthy. We'll see how Apple, what they say in terms of the very, very early days with the new cycle. Apple Intelligence, of course, is rolling out, and we'll see a lot more there in the weeks and months ahead.
It's a binary bet on the election. If he wins, maybe it does something, but I think it's a buy the rumor, sell the fact. So I would imagine that the day after him winning, you'd see this come down. If he loses, I think it goes to zero.
For the first time in my lifetime, I'm actually becoming very concerned. The fact that the deficit is now, $3.5 trillion a year. We're going to 36 or $37 trillion in the overall budget deficit, or the debt that we have. That becomes problematic, and I think it is, for the first time in my lifetime, disconcerting.
We've got 1 hour to go until the market close. We're taking a look at the major indices right now. All three are higher. The Dow Jones Industrial Average up about 0.8%. The Nasdaq Composite up about 0.5%. S&P 500 a little bit less. Right now, Josh, it really just feels like kind of wait and see ahead of a big week of economic data, a big week of earnings. You have the election next week. You have Fed next week. One thing I'll highlight on the S&P 500, little fun fact for you. Today is the best day on average for the S&P throughout the whole year. October 28th. Our friend Ryan Dietrich over at Carson Group highlighted that.
Dietrich always has the data.
Today's also his birthday.
Is it?
So
happy birthday, Dietrich.
Unironic that he remembers that, right? But we're tracking around for that. It's usually about 0.5% gain that we see today. I don't think that's exactly what's driving us, but like I said, it seems like a lot of factors later in the week are really what investors are waiting for right now.
I mean, it's your calendar is so stocked up right now. I mean, you've got economic data, Schaefer, you got big tech earnings, Fed, election, and we'll be asking some strategists, when you look at that whole picture, what exactly they're trying to prioritize.
And then there's going to be a lot of movement perhaps within the index as we get later in the week, right? But I want to move to one thing that is moving right now, Josh. If I can find our oil board here. Here we are. Oil off about 6%.
Big story today.
Big story today. Easing tensions in the Middle East, perhaps the story being that oil plants weren't hit, right? There were fears that we might see that as we've been pricing in tensions over the last 2 months here, but the story being that didn't happen, seeing a big tick down in oil.
Yeah, so Israel, strikes Iran over the weekend on Saturday. As you noted, Josh, they don't hit Iran's crude facilities, so maybe there's this sort of a bit of a sigh of relief from investors that, hostilities could ease here. We did talk to oil gurus on the show who were saying, absent geopolitical tensions, they were telling us, in their opinion, path of least resistance, at least near to intermediate term, they thought was lower.
Yeah, so we're starting to see that move now. And a final thing I want to hit on here, Josh, because we just talked about the economic data. We're seeing a tick higher in the 10-year yield again, up near 4.3%. That would be the first time we've been there since early July. So again, it will be interesting to see. Tomorrow you have JOLTS data, Wednesday is GDP, Thursday PCE, Friday a jobs report. What does all of this data mean for the 10-year? Right now it has been stronger data has been driving this move, stronger than expected economic data. So do we get more strong data that maybe leads to higher for longer? Does it come in a little bit weaker and we start to see some weakness in this tick higher we've seen?
Yeah, investors trying to make sense of what yields are trying to tell us here as we back up to this 4.3 level. I mean, to your point, Josh, we have gotten economic data. It's coming better than expected. The question is, what if you move higher than 4.3, which we've talked about a lot?
Absolutely. And one other thing I'll take a look at here, I just want to highlight the sector action, Josh, because the last time I looked, there we are. 10 of the 11 sectors in the S&P 500 in the green. Pretty broad-based drift higher, I would argue today, and that's sort of what we've been watching throughout the day thus far.
Let's get another smart take on these markets. For more on today's action and what is ahead this week, let's welcome in now Ross Mayfield, Baird investment strategist. Ross, always good to see you. Let's start off with earnings. We had the busiest week of corporate earnings, Ross. I'm just curious, bring us up to speed. What do you make so far of this earnings season, what you've seen, what you've heard, Ross, and of course, with big tech earnings on deck now?
Yeah, I mean, let's start at the 30,000 foot view, right? Earnings are heading higher, right? We can quibble about beat rates. You can look at margins, but broadly, we went through a 2-ish year period where earnings were flat. They were volatile. Now we have earnings on the rise again. They're beating, analyst expectations at a pretty solid clip. Profit margins are expanding. So the big picture is things look pretty good. And when we head into 2025, I think one of the themes has to be, all right, multiples have expanded a lot. We've had a lot of enthusiasm around some new technologies. At a certain point, earnings have to take the baton. I think we're in a good position for earnings to do that, whether it is the Mag 7 or whether it is the other 493, which are starting to see improving earnings breadth as well.
Ross, we're getting reports from over 160 S&P 500 companies this week, right? But that also comes with a lot of economic data, an election next week, a Fed meeting next week. Can earnings take the baton right now, or is it setting the stage for once we get through this volatile period, maybe for investors to look back and say, oh, those earnings we didn't pay as much attention to as they were happening were pretty solid?
You know, it might be good for my job security as a strategist, but it does feel like the macro always comes to the forefront over earnings. And we always just look back after the fact and say, hey, earnings were pretty good. Or, maybe there's 1 or 2 big companies that beat or missed. But, in the interest of job security, I think it's rates. I think you highlighted it. Rates are moving higher here on better economic data, but there is a point where that starts to squeeze on equities a little bit. And I think that focus or that dichotomy is in play here over the next, call it 10 days when we get all this job market data, which is the big thing for the Fed at this point. We get PCE, and then we actually get to hear what the Fed thinks about things. The election to us is not as important as what is the 10-year doing, what is it trying to tell us, and then what does the labor market look like at the end of the week.
What levels are you watching there, Ross, in the 10-year? At what point do you start to get concerned, and maybe what areas of the market would you be concerned about should the 10-year move to those levels?
Yeah, well, I'll say 2 things. First, our partners at Strategist have done some great work this year and looked at that 4-5 level as a pretty important level for whether, it's good or bad, to put it quite frankly. But the other thing we're watching is, all right, 10 years moving higher, but what is leadership in the market look like? What are credit spreads doing? And both the risk on leadership in the market, you showed the screen today, financials leading, we've seen discretionary doing quite well, industrial is doing well. So you've got this risk on leadership that's not signaling defensive posturing. And then credit spreads are still just extremely tight. There's been no cracks in the credit market. And that's another thing that we'd look at. If there were something building under the surface, we just don't see it yet.
And Ross, let's get to big tech earnings because they're on deck as well. What do you expect to hear generally from those Mag 7 names, and how important is that performance for the market?
The performance, the actual numbers are important. Obviously, the NVIDIA report has been one of the big market drivers every quarter over the last couple of years. I think that there's a waning or enthusiasm for AI, or maybe I should say it's becoming more of a show me story. We know these companies are pumping a lot of CapEx into building out the infrastructure. I think that investors want to hear from leadership how it's going, right? Are we making strides? Are we seeing adoption? Are companies outside of the big tech world adopting some of these technologies? So I think it's very much, we want to see the numbers, but I think more so it's about guidance. It's about, are companies in the consumer staple space, in the utility space, are they inquiring? Are they spending on your products? I think those updates from leaders are going to be really important because we know that these are great businesses with a lot of cash, low debt, but at this point they're trading on AI. Their lofty valuations are AI linked. And so the investors are going to want to hear positive updates there. Otherwise, it could be a bit choppy as it has been for the last 3 to 6 months in that space.
Ross, I want to shift back to the macro a little bit here. I know you're expecting a 25 basis point cut from the Fed next week. As we talked about, a lot of data between now and then that could perhaps move that either way. Where are you viewing the risks at this point? Are the risks skewed to a no-cut November, or the risks skewed to maybe a weak labor print due to some weather-related instances, and then all of a sudden you're looking at a 50 basis point cut? How are you sort of evaluating that?
Yeah, it's a great point. I mean, my prediction for 25 basis points is as good as useless given all the data between now and the Fed meeting. I think the bigger risk is for a no cut, right? If you get weak labor market data, I think the Fed would be able to look at it and say, well, we've had so much weather weirdness. We've had these hurricanes. We're not going to overreact to what could be a noisy and unreliable data set. On the flip side, if despite all that, you have blowout job numbers and maybe a reacceleration of wage growth, I think the Fed could look around and say, do we need to cut? If it's proven that this was, not real or that the data was noisy, they can always do 50 again in December. So I think the risk is that the market is priced nearly 100% for a 25 basis point rate cut in November. We think it'll happen, but I think the risk is that the Fed sees strong data this week and decides to wait until December.
Ross, let's talk seasonals for a minute here. Sam Stovall reminding us that the stock market is about to enter the best 6 months, meaning that November through April timeframe. How much, as a strategist, Ross, how much emphasis you placed on seasonality?
Well, when I'm feeling bullish and it kind of confirms my priors, I'll take it. Obviously September and October are supposed to be these seasonally tough months and kind of didn't live up to their reputation there. August did a little bit. I think the really important thing is that, one, you're right, it's a seasonal strong patch. There's a lot of, structural reasons for that. The other thing that we've been reminding clients of is how stocks have performed in the aftermath of the last two elections. You've seen an average of an 11% pop over the 3 months following 2016 and 2020. That's really aggressive move. That's the kind of move that you don't want to be on the sidelines for. So we have a lot of clients who are kind of waiting for the certainty of the election to pass. We'd urge against that because you've got that seasonal strong point. And then once you get past that election, the past 2016 and 2020, it's been off to the races.
Ross, always good to see you. Thank you for helping us kick off the show. Appreciate it.
Appreciate you all.
Oil prices plunging today. It's after Israel spared Iran's crude facilities in attacks over the weekend. Yahoo Finance's Inez Frey is here with more. Inez.
Yeah, Josh, and the big drop today, about 6%, has everything to do with geopolitical risk premium coming out of the crude market. Demand will be now the focus and seasonally low this time of year, by the way, until the cold weather really kicks in. Traders are paying attention to China, and the next big catalyst could come closer to December when OPEC Plus is scheduled to start unwinding some of its production cuts at the end of the year. That's been a move that's been postponed previously, so we'll have to see with that. Citi analysts have already lowered their price target on Brent, saying beyond the conflict, sustained concerns about demand, especially in China, remain a major overhang for prices. The analysts now have a 2024 price target on Brent for the fourth quarter, that's this current quarter, of $70 versus $74 for this current quarter. And you can see that year to date, we've got WTI that's in the negative, down 4%. Year to date, Brent crude is down 6%. I also do want to mention some of the other futures that were tumbling today. Gasoline futures down 5%, natural gas down 10%, heating oil futures down more than 4%. This actually bodes well when talking about input costs for companies, and no better chart shows this than today's airline chart. So you can see the airlines are all up, Delta and also the cruise liners as well, guys.
Inez, thank you. Appreciate it. And we are just getting started here on Market Domination. Coming up, it is a make or break week for the Magnificent Seven, with 5 of those key names set to report earnings. Going to preview what to watch from big tech right on the other side. Plus, shares of Trump Media and Technology Group soaring higher as Election Day approaches. We're checking in on some of our top trending tickers later in the hour. And at 4 p.m., it's the latest earnings results from Ford. We're going to get you the numbers and analyst reaction as soon as they cross the wire. Stay tuned. Much more Market Domination still to come.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Apple unveils the new iMac featuring the M4 chip and Apple Intelligence. The tech giant also releasing its first set of Apple Intelligence features for the iPhone, iPad, and Mac. The latest offering is coming ahead of the company's fourth quarter results on Thursday. And Oppenheimer senior analyst of emerging technologies and services, Martin Yang, joins us now with more on what to watch for with the tech giant. Martin, it is good to see you. Let's start with Apple pushing out these new AI features, Martin. And of course, the big debate on the street still is, are those going to really help to jumpstart this meaningful iPhone upgrade cycle, Martin? To that, you say what?
I think it's going to take time, maybe a few quarters. For example, the 18.1 iOS and iPad update were released today. I just downloaded it, but Apple Intelligence is not immediately accessible. You have to join a waitlist and then get notified to use the features. So the rollout is gradual. It takes time to get global consumers or global iPhone and iPad users to access the feature. We don't know how the broad-based consumers will respond to those just yet.
Martin, what's the read on Apple Intelligence as far as what consumers are going to be getting from the product? Is it the kind of AI intelligence that's going to get someone to move over from a competing, say, smartphone company that also has a lot of AI integrations into Apple? Is that the play here, or are they just trying to make the experience better for customers that already exist and people that are already in the Apple ecosystem?
I think it's the latter. It's going to get the existing users upgrade to newer devices. A lot of the older phone users have been on their much older device without Apple Intelligence support for quite a few years now. So it's primarily targeting the existing user base as opposed to switchers.
Martin, I'm going to double barrel this next one to you, a two-parter. One, do we have any line of sight yet, Martin, on when these new AI features are going to get turned on in China? And two, I'm just curious, Martin, is your sense that why do you think people are upgrading to these new iPhones? Is it the software, or is it actually still just tried true hardware? Is it the better battery, camera, display?
I don't have a line of sight on when Apple Intelligence will be available in full feature in China. And for a second question, I think it's a combination of both. Number one is we are dealing with a very large 300 million plus install base who are on their older devices for 4+ years. That's one. So those users are looking for hardware-specific upgrades, such as a GSPC port, better display, and more powerful processing features. For users like me who are on a 3-year-old phone or 2-year-old phone like my wife, then we'll be looking to upgrade with solely software features like the Apple Intelligence, making our daily lives just a bit easier.
Martin, we talk a lot about that iPhone upgrade cycle, right? And that seems to be across the street a key part of the bull thesis here. If that doesn't come to fruition, or at least doesn't come as intensely as some are projecting, is there still a bull case for Apple? Maybe services picks up more than expected, or they pull another lever, or do we have to see that iPhone upgrade cycle?
Yeah, I wouldn't rush to say software cycle is coming up because of wider use of consumer-facing intelligent features like ChatGPT on the phone. So we're still waiting for a killer feature like what we have identified for mobile games for the software development, for the software part to take off. So if the hardware story or the upgrade cycle doesn't play out, it will be immediately a short-term negative for Apple.
So Martin, more immediately when Apple does report results this week, your big questions that you want answered are what?
Yeah, there's not a lot of major debates going into Apple's quarter. Things we'll be watching for is the iPhone revenue trend still stable, and are they keep getting better comps in Greater China sales? Those are the key topics I'll be watching because we are expecting the headwinds from the competitor point of view in Greater China to moderate since 2 quarters ago, and expect that to continue into the September and December quarter. And overall, we are expecting the revenue growth to stay in that mid-single-digit range.
Martin, we were just talking about Apple Intelligence. I'm curious what you're expecting, if anything. Do you think we're going to learn any more about that on the call or future AI plans, or do you think that's already kind of sort of baked into the price of Apple stock at this point?
Yeah, I don't think Apple is in the habit of revealing new features for their hardware devices on the earnings call. So we are likely to get a reiteration of the announced features of Apple Intelligence on the call, but nothing beyond that.
Martin, in terms of what you're looking for when they report this week too, how do you think about the margin story here and the trajectory of margins looking ahead? Because they have been hanging in there, Martin, right? I mean, Apple fans have been opting for those, higher price Pro models.
Definitely, we see 2 things playing out. One is a heavier focus on Pro and Pro Max models, and the other is service revenue still growing at far above the rate of hardware devices, service growing at 10 to 15% range, whereas the hardware growing at mid to high single digits. So that by nature will help Apple to move up the gross margins overall quite sustainably.
Martin, plenty to think about before Apple reports earnings again after the bell on Thursday. Appreciate you joining us.
Thank you.
It's a big week for chip makers. On semiconductor shares rising today after reporting earnings for the third quarter. AMD and Intel also reporting third quarter earnings later this week. Joining us to talk more about the chip sector is Christopher Rowan, Senior Equity Analyst of Semiconductors at Susquehanna. And Chris, I want to start with what we saw from On Semiconductor earlier this morning. Any sort of read through from what you hear from them about what we might hear from other semis as we kind of continue through earnings season here?
Yeah, we were bracing for a very challenging earnings season, particularly around auto and industrial. And On Semi put some of our fears aside. They are doing particularly well in China, into the EV market that's doing well in China right now. And On is gaining share in a technology called silicon carbide going into those electric vehicles.
Chris, I want to switch gears. I want to talk about another name you covered that I know you like, AMD. Those earnings also on deck. Top of mind for AMD investors, Chris, in this report, is it client, is it server, or really no, it's AI. Is AI just top of mind still?
Yeah, it's AI, Josh. Everyone wants to know, MI300, how are orders going to progress for the rest of the year? And looking into next year, what does that book look like? Is it filling out? What kind of year-on-year growth should we expect? I don't know if Lisa's going to give that number. I think she's going to shy away from giving that number. But people think that MI300 could double the size of the company overall. And so this is a very important kind of linchpin in that report.
And Chris, moving to another name you cover, also in the chip sector, of course, Intel, right? Intel stock's been beaten up pretty good this year, down over 50% now year to date, fell pretty heavily on earnings last quarter. What are the expectations coming into this quarter, and is most of the bad news in the Intel turnaround story perhaps maybe already out there?
Yeah, well, I would say sentiment is low. Results have been low. Expectations, I think, are low coming into this report. There's not much to love. I think the PC market is kind of ho-hum right now. The server market is good for AMD, but I think Intel is experiencing some share losses. And then in the PC market overall, they do have a good new product in Lunar Lake, but it actually runs on TSM silicon, which is a problem for them as they're increasingly trying to move over to their own. So maybe even gross margin could be a headwind for Intel on this next report. These are all the things that investors are thinking about.
What about these reports we saw, Chris? Qualcomm kicking the tires on Intel. I mean, you cover both names. You know them both so well. I mean, would that make sense to you strategically?
It would, although I would say Qualcomm probably has very little to no interest in the manufacturing operations of Intel, the foundry strategy. Intel would probably find a way to cleave off that part of their business and just sell the design business to Qualcomm. But truthfully, I really don't see how this is going to happen from a regulatory approval. I would put the odds very low of such a deal.
Chris, we've been talking for a couple minutes about chips, and I haven't mentioned it yet. We got to talk about NVIDIA at some point, right? I know they're not reporting this week, but I am curious, through a week of both chipmaker reports and the hyperscaler reports, maybe separating those two out, what can you glean about what we'll hear from NVIDIA in a couple weeks from A, the chipmaker reports, but B, also what those hyperscalers tell us about what they're spending?
Yeah, so far, in terms of our supply chain checks, they're all coming back positive. We do think there is some degree of upside, not as large as we've seen in quarters past. Part of the problem here is Blackwell delays. Jensen has now kind of confirmed and held our hands and told us that this is coming indeed. But at the same time, we do believe that this ramp is taking slower than expected. Additionally, systems are really going to be coming next year, and that's where the volume of revenue is going to be for Blackwell. So we're really worried about that transition period. Not overly worried, but we've had a habit of beating analyst expectations by, call it, $2 billion a quarter. And we think that in the next guide, that might be the narrowest we've seen yet, just because of these system delays into next year.
You talk to analysts, Chris, about NVIDIA, and it's interesting, not near to intermediate term, but you'll ask them who do you think poses the competitive threat to Jensen long term, potential competitive threat. They'll often say they think it's AMD, and they'll say it's the hyperscalers, the cloud giants, Jensen's own customers. You agree with that?
Yeah, and I really think it is the hyperscalers themselves. We're seeing, we've seen Google TPU ramp for many years now, but if you look at stocks like Marvell, for example, they're adding what seems like a new data center customer every single quarter with one of these initiatives. And we know that Meta has a part coming, Amazon has two, Microsoft has one in AI, ByteDance has another in AI. So we're just seeing these AI competitors stack up one after the other on the hyperscaler side.
A race we will certainly continue to follow. Chris, appreciate you joining us today.
You got it, guys.
Coming up, another chip maker in focus today as shares of Taiwan Semiconductor are sinking. We'll get you the details when market domination returns.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Now time for some of today's trending tickers, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, let's take a look at Taiwan Semiconductor. The chipmaker reportedly suspending shipments to China after a chip it made was found on a UI processor, according to Reuters. This would be a violation of trade restrictions. So Josh, Taiwan Semi trading a little bit lower on this today. Of course, those restrictions in China have been a key headwind for them and potentially other chip makers as well, right, for where their business is going to go there. But the stock had been doing well after earnings, right? They talked a lot about strong AI demand. They have been having pretty good momentum. So a little bit of a headwind today, perhaps hurting what seemed to be a bull case emerging post-earnings.
Yeah, I mean, it's a good point. I mean, listen, we care about TSMC because they are the world's largest contract chip maker. You know, the clients are just a who's who in tech, right? It's Apple, NVIDIA, Qualcomm, and on and on. And it's an interesting story. Again, this is Reuters, and they're citing sources basically saying, listen, TSMC suspended these shipments, this China-based chip designer, after a chip it made was found on a Huawei AI processor. Huawei, of course, restricted from buying the technology to protect U.S. national security. Reuters is saying they could not determine how the chip ended up on the Huawei product. And this company is denying any business relations with Huawei, provided an investigation report to TSMC, but a big name that obviously attracted some headlines.
And it seems like when we've seen this with the China chip story over the last year, it's been something that will weigh on a chip stock for a day or two. I'm thinking about perhaps NVIDIA, right? We've seen that trade on headlines like this before. And then as more details come out and it becomes a little bit more clear, hasn't necessarily been a long-term headwind because it seems like we've struggled to just get full details on exactly what this means for the overall fundamental business here, right? And okay, is this a long-term issue or a one-off where the chip was there by accident, it wasn't entirely on purpose, and it's not really part of the overall story, and it seems like we perhaps need a little bit more detail here.
And hopefully we will get it, Joshua. Yeah. All right. Next, let's take a look at shares of Robinhood as it rolls out contracts to bet on the U.S. presidential election. Look at that, nice pop in the stock of about nearly 3.5% in today's trade. So good news, Josh, if you want to bet on election outcomes. Robinhood giving people a way to bet on whether it's going to be Harris or Trump that's going to win, rolling out event contracts for the election, which is a kind of financial derivative.
Yeah, this really, I think, is very interesting, right? Because we've talked a lot about, say, Trump media stock and that being a speculative way to bet on the former president winning, right? Or maybe you go into the Trump trades and you're trading energy stocks or something like that. Robinhood offering you direct play.
Yeah.
If you think Trump or Harris is going to win, you can just place that bet like it's a sports book. What I think is interesting here, Josh, is perhaps maybe a little bit of a different business than Robinhood's normally in, right? They're essentially taking direct bets here. They're going to have to pay those out eventually, and it is not the same as offering stocks, where at some point, I could exit my stock position tomorrow, you could exit your stock position the next day at a different price. If you're selling just these bets, you're going to have a lump sum that you need to pay out at some point. And we know every now and then the house always wins, right, in gambling, but every now and then the house does get burned too.
Yeah.
So there's a little bit of that exposure being presented to the business here.
So much interest in this, and these firms looking for a way to leverage that. And others have jumped in too, right? So Interactive Broker is also offering this kind of event contracts. What's also interesting, after the election, does Robinhood sort of expand this?
What other events can you do, right? Are we going to bet on the
like-
Oscars
right.
or like what's
economic
next?
outcomes, the weather? The company did tell MarketWatch, listen, we're just focused on election contracts first and foremost here. But you could see,
I bet on
how
weather.
this rolls out and popular. Yeah, why not? Why
The
not?
sun always comes out tomorrow, Josh. That bet, not bad, right? Maybe. All right, turning to Philips as shares slide following the company's lackluster outlook. The company trimming its comparable sales forecast for the full year, citing deteriorating demand in China. Philips CEO Roy Jacobs telling Yahoo Finance earlier today about the move behind adjusting its outlook.
We think that actually China will come back. The question is not if, but it's when. And currently the visibility is just very low, and that we had to reflect back in our forecast also moving forward to the full year.
So Jacobs highlighting there that the issue is not if, but when. And Josh, that seems to be the issue that the market is hung on today as we're seeing Philips stock tumbling pretty decently here. It's, well, when is that turnaround going to happen, right? When are we going to see that play out?
That's it. So they cut their annual sales growth forecast, right? So now they're looking for comparable sales to grow as much as 1.5% in 2024, Josh. That is down from previous forecasts of as much as 5%. I did see analysts from Barclays cited saying, listen, that outlook cut said is disappointment. It raises questions around 2025 and presents, they said, a negative read across to peers on China worsening. You can see the reaction there.
Yeah, something we'll have to keep an eye on, I think, as we move forward.
For sure. All right, finally, how about nuclear stocks in rally mode to start the week as speculation grows on how much power is needed to support AI? We did see some nuclear power stocks and uranium miners, by the way. They were in the green in today's trade. I saw reports putting this one, Josh, coming ahead of the restart of a nuclear reactor in Japan.
Okay.
This was scheduled to restart its reactor. This is per reporting, by the way, citing comments made by Japan's trade minister. The first reactor to restart in the eastern part of Japan, which has apparently had to deal with these kind of chronic power shortages. But interesting, I mean, it seems like every day, almost every week now, for sure, we're getting these headlines.
I was going to say, when I saw these stocks moving,
yeah.
I took a little bit of a zoom out and, okay, the AI hype trade has just moved to nuclear stocks because we know that's what a lot of these companies are looking to do now, right, is go get nuclear energy.
Yeah.
Who operates nuclear energy? You're looking at 3 names on your screen. Look at the 3-month returns, Josh. I mean, you're looking at Aqua up over 160%, right? NuScale Power up over 100%, Centrus Energy up over 100%. These are massive moves. And so at some point, you're just starting to see the AI-like momentum build here in the ways we've seen it build in other areas of the market, right? We know once that trade gets moving, there's a lot of momentum behind that. And at some point, it's hard to maybe reason what the move is. It's not fully maybe a fundamental story yet. It's, okay, we think things are heading here. We know AI is huge. If it's going to require nuclear energy, then someone's got to benefit. Maybe it's these guys.
Well, we've had sort of analysts come on and say, listen, bottom line, like if you look at electricity consumption, it hasn't grown all that much over the last couple decades. But now, of course, they see that changing and accelerating, and they'll point out the grid just isn't prepared for that. So no surprise, you have folks now searching for alternatives, and a lot of investors are betting it's going to be nuclear. It's going to be one of them.
And we have the perfect guest to answer these questions for us.
We really do, Josh.
For more on this narrative in nuclear, Yahoo Finance will be speaking with Aqua CEO Jacob DeWeet tomorrow at 3:30 p.m. Eastern.
And coming up, we're taking a look at the best ways to be positioned among social media stocks with today's investor playbook. Stick around, much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Time now for some calls of the day. Monness, Crespi, and Hart raising its price target on PayPal from 95 to 110. Joshua, results, of course, expected tomorrow. Stock has enjoyed a nice run already. It's about 35% this year. Analysts, they reiterate buy, they tweak their estimates, they raise their target to 110, remain bullish, based in part, they say, on their intra-quarter checks. Key U.S. e-commerce indicators they tell their clients point to a solid quarter.
Yeah, Josh, and you mentioned that stock move that we've seen really over the last couple months now in between earnings, and several other Wall Street analysts have pointed out maybe that's a reason to perhaps be cautious on the stock. So you're looking there on your screen, up last 3 months, up over 40%. Yeah. So analysts at Morgan Stanley saying they feel like investors have moved to be a little bit more bearish, noting that perhaps some of the tailwinds that investors have thought are coming maybe aren't coming until later in 2025. The team over at Jefferies also highlighting that. They said our concern is the stock has run on hope for contributions in full year 2025 that might not come as soon as people hoped. So perhaps given the stock move, there's a little bit of the bar has been raised into earnings tomorrow morning, and it might be hard for PayPal to beat and raise.
Monness, Crespi, and Hart, thinking the other side of that trade, though. They're bullish.
110, that's a bullish price target, too. That's a good run-up.
What are they looking for in the print, among other things? Besides bottom top, they say the rollout and economics of Fastlane, that's their guest checkout product, and monetization of Venmo, pricing discipline in the industry, all top of mind, Josh.
All right, moving on to another stock we're watching, Josh. Macquarie upgrading NEO from neutral to outperform. The note highlighting the company's Q4 guidance. They're expecting that to come in better than expected. Also taking a look at the prospect for NEO to have this low-cost EV model, Josh. That's a big part of the investor story here going into 2025. The potential development of a low-cost EV model, what sort of demand that could drive. NEO stock up about 10% today, perhaps maybe partially driven by this note.
Pull back that chart, though.
The chart has been ugly, right? And I think that's part of the story here with NEO. If you were to look at a chart going back to, say, 2021, it was a $60 stock. It was a $60 stock in 2021, right? So we're talking about a much different company that has struggled to sell EVs over in China. And so there you go. There's the max look right there, right? So will that story really change materially for NEO? I think that might remain to be seen.
Yeah, stock's down about 35% this year. Most analysts tracked by Bloomberg, though, say that is an opportunity. I mean, most like this one. They say it's a buy. Macquarie says we see there is upside potential for NEO to release stronger than expected guidance in Q3 earnings. We expect volume to accelerate in Q4. They talk about strong orders of a new mass market model, to your point, Josh.
That mass market model, too, just makes me immediately think of Tesla always, right? If they're to launch a mass market, low-cost EV,
more
does
affordable.
that put more pressure on Tesla and sort of some of their international sales? Something to watch.
We'll see.
No doubt. All right, shares of Trump media and technology extending a 5-week streak of gains following Donald Trump's rally at Madison Square Garden in New York. For more, we're bringing in Yahoo Finance senior reporter Alexandra Canal. Ali, we're seeing a large move higher in DJT stock today. What are people attributing it to? What's going on here?
Yeah, I mean, shares are up 20%, adding on to this massive rally that we've seen over the past several weeks. Now, a lot of the gains are due to betting markets, both domestic and overseas, tilting in favor of the former president winning the election. That's just around a week away, guys. Crazy that we're almost here. Although I will say that national polls, it's a much tighter race, especially in those key swing states like Pennsylvania and Michigan. But this is a stock that does not trade on fundamentals. It quite literally trades off vibes. If there's any negative press or negative headlines around the president is odds of winning in November, you're going to see that reaction in the stock price. Now, because of that, the gains that we saw today, it's unlikely that that's going to hold to come next week. Earlier this morning, Yahoo Finance did have the chance to speak with Matthew Tuttle. He's the CEO of investment fund Tuttle Capital Management. He's a current investor of DJT. He owns put options on the stock. So here's what he had to say about where shares could be heading. Take a listen.
If he wins, maybe it does something, but I think it's a buy the rumor, sell the fact. So I would imagine that the day after him winning, you'd see this come down. If he loses, I think it goes to zero.
So a lot hinging on November 5th. A binary bet on the election is how Matthew Tuttle described it. But as a business, this is a company that's bleeding money. $16.4 million loss in the second quarter, revenue down 30% year over year. And if you think about the need for True Social, especially with all the other social media apps that we have, you might not need it anymore. I mean, Trump is back on X. We have Elon Musk controlling it. A lot of the censorship issues that Trump really decried about when he created this company is not really an issue anymore, at least from the perspective of some of the ex-users. So where does this company go from here, especially after the election, I think is a big question mark. But based on current levels of above $45 a share, Trump's stake is worth around $5.5 billion right now, and he can cash that in at this point. He said he's not going to. He said he's committed to riding out, this company, this stock. But if shares do go down to zero, that's a heck of a lot of money that he could potentially be losing out on. So we'll see.
We shall. Allie, thank you. Appreciate it. Moving on, it has been an interesting few months for social media companies. Meta is all in on AI, of course. Reddit has watched shares surge nearly 80% since its March IPO, and Snap has seen its stock tumble after hitting a 2-year high in late April. Each will be reporting earnings this week with some very different expectations. With just a few minutes left till the closing bell on Wall Street, we're looking at how to navigate social media stocks with the Yahoo Finance Playbook. And joining us now is Andrew Boone, equity research analyst at Citizens JMP. Andrew, it is good to see you. So maybe to start just kind of higher level, Andrew, you look across your coverage universe, digital advertising. In general, how would you characterize how healthy, how strong that space looks as we head into these earnings, Andrew?
I think advertising overall has been stable. That's kind of what we're hearing in terms of the advertisers that we're speaking to in terms of the publishers. I think that's been stable kind of over the last year or so. And so we expect something that's kind of similar in terms of what was 3Q and then into the holiday season here in terms of stable consumers, stable advertising budgets. I expect more or less more of the same.
Andrew, I want to move to the AI story among the social media companies. We have several companies reporting this week: Reddit, Snap, I should say, Meta. Is there an AI story within all three of these? If I'm an investor looking to, say, invest in AI disruptive tech, is there one that's better positioned in terms of how they're going to monetize AI?
I think Meta has proven to be the most mature in terms of the three that you mentioned for AI. I put Meta and Google both up there in terms of companies that are operationalizing their technology development of just LLMs, broadly speaking. So what does that mean? I think it's more contextually relevant, engaging content. You've seen that in terms of Instagram continuing to take share of time spent. We see that in third-party data. And then for Google, it's really been just more relevant ads, right? And so what you've seen is Google searches with 5 or more words. That's growing 50% faster than simple searches. And so what you're seeing is for search, you now have a better understanding of what the inputs are, which is just leading to just a greater growth of queries overall. And so I would say both those two companies are benefiting. Reddit is a little bit earlier, and Snap is also a little bit earlier in terms of what they're doing with AI. But again, I would say those tailwinds are coming across the entirety of the space.
Andrew, do I stick with Meta here even after this move in the stock up about 60% this year?
Yeah, we really like product-led stories. And I think Meta's product-led story in terms of engagement with AI, as well as the AI gains that they've gotten in terms of improvements to their core ad models, both suggest that these can continue. And I mean, I think just stepping back, if you think about the broad gains across just LLM development, right, that we're constantly hearing about, I see no reason why that wouldn't continue in terms of this quarter as well into the next few years.
Andrew, you mentioned product-led stories. You recently upgraded Snap, and it seems like that has to do with some of the turnarounds they're making to the product itself, right, within the app. Can you just explain maybe that upgrade for us and why you think Snap's a buy right now?
Yeah, really simply is the way that I think the market works today is that you have to get in front of third-party data, right? You need to be in front of before investors start to see this come through either in credit cards or time spent or whatever else this looks like. Snap is going from 5 screens down to 3. And so within the framework of them simplifying Snapchat, it should be easier to use. And we just very simply think Spotlight is a better product than that we're offering with Discover. And so if you look at what Snap has told us in the past, it's all about Spotlight driving engagement, time spent on the platform. And so should you start to see Spotlight, now that it's easier to access, now that there's a simpler on-ramp with just 3 screens versus 5, we think that engagement can start to improve with Snapchat. This is we're hearing basically advertisers come back to us and saying, for large performance advertisers, Snap is doing a better job in terms of driving ROAS. So return on ad spend has improved for Snap as they've just done a better job progressing their advertising models over the last couple of years.
Another name I want your take on, Andrew, because it's an interesting story, is Reddit. And one question I know investors have there is, how much money can Reddit really make here licensing its data to train AI models? How do you think about that, Andrew?
It's analogous to what we've seen in the past. And so Twitter, before the AI explosion happened, and Twitter was not selling into a Google or into an OpenAI or into the other kind of major contracts that we've heard Reddit announce, they had $100 million a quarter of data sales. That's not completely clean, but it's a really good guide to us of what can be recurring revenue for Reddit over time. And so I still think it's really early in terms of Reddit selling into social listening platforms, financial firms, other companies that just need data overall to be able to develop models, while it's still really early in terms of AI training. And so as more companies start to develop AI models, and again, where's Apple on this? We think that it's still really early in terms of Reddit's data sale opportunity, and that represents upside, at least for our model.
And Andrew, I'm curious with that though, with Reddit, do they have to get further into the AI space, for the stock to be an own then, right? Because they're not that far into that space at this point as far as them selling their own data. Is that an absolute must-have if I'm an investor in Reddit?
What I think is a must-have is on the product side, right? And so what I want to see the AI gains is I want to see them on a more relevant homepage. And look, Reddit has already started to do that. If I just look at my own personal usage, I've ramped my Reddit usage over the last year because they've done a better job of making posts more relevant whenever I open the app. And I think that can continue to have legs. On the advertising model, again, it's a lot of the same stuff that we just talked about for Google and Meta, where I think Reddit can do a better job of making ads more contextually relevant. Some of that is simply selling into more advertisers, right? So the more diversity you have on the creative side, on the advertiser side, on the objective side, means that you do a better job of matching those ads with the users. But some of that is also just the algorithm. And so I would point you more on the operational side versus just the data sales side in terms of what AI can do to that business.
Andrew, we appreciate your time and those picks. Thank you, sir.
Thank you.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
And that's the closing bell on Wall Street, and now it's time for Market Domination Overtime. We're joined by Jared Blickery to get you up to the speed on the action from today's trade. And let's take a look at where the major averages ended up. So you can see the Dow Jones Industrial Average closing up about 0.6%, the S&P 500 up about 0.3%, and the tech-heavy Nasdaq also up about 0.3%. Markets largely sort of drifting higher today. We know a lot of data coming later this week, big tech earnings coming later this week. Feels like a little bit of a wait-and-see day today, Jared, but I want to take a closer look at what happened among the sectors. Jared, I know you have that breakdown for us.
Well, thank you, Josh. Yes, it's all queued up for me like magic here. Let me just show you. Energy was the sole sector in the red today, and that was caused by the biggest drop in crude oil since 2022. Those Israeli strikes on Iranian targets, not quite as bad as markets thought they might be. So here's the number one sector right here, financials, XLF, 1.2%. And this is really interesting. I got to show you guys the bond market real quick because the 10-year T-note yield has just been tearing higher, and it actually shot up to 4.3% today, highest that we've seen in quite a long time. And it's getting into territory where it could disrupt equities. And I'm going to be talking about this with Josh Lipton in about 30 minutes. Excuse me there. But you can see in the last 3 months, definitely the highest yield there. Let's go back to our heat maps here, and I want to show you what's been happening with our leaders. You don't see a lot of red here either, but Bitcoin has been heading higher. Bitcoin itself approaching 70,000, so that's something we're watching. Chinese stocks, those are on the move today. KWEB up 3%, and regional banks as well. Regional banks like the expanding yield curve, and that could be the story there. I'm going to close here with the Nasdaq 100, a mixed picture. Admittedly, NVIDIA backing off of those record highs that it hit last week. That's down 0.7%. But Apple continues to consolidate near highs, and I just want to show you, looks like it's ready to break out, just waiting for it to do so. Guys.
Thank you, Jared. Markets starting the week on an upbeat note while we're heading into a seasonally good period for stocks. There are a lot of events happening in the next week. We got earnings, the election, and the Fed decision, just to name a few, which will be key drivers. Well, joining us now is Eric Wallerstein, Yardeni Research Chief Market Strategist. Eric, it is good to have you on the show. I want to start maybe with yields, Eric. And I'm curious because you look at the 10-year, we backed up near 4.3. I'm curious, Eric, what do you think the message is that yields are sending us right now? And is there a level you'd be watching where you think, okay, that's when we could see a squeeze on the equity market?
Yeah, I mean, I think the run up from around 3.6%, just as the Fed was cutting, all the way up to 4.1, 4.2%, was really a combination of two things. Economic data came in way stronger than a lot of people expected. We had upwards revisions to previous months. We had stronger GDP, stronger GDI. We had a really good payrolls report in September. And then we also had the Fed cut by 50 bips. So I think the message the bond market is sending is the Fed did too much and too soon. And then I think, a lot of people are equating this to rising odds of a Trump victory in just a week or so. I think that's a little bit of, nothing changes sentiment like price. I think a lot of the run up in yields, at least to 4.1 and 4.2%, had to do mostly with economic data in the Fed. I'm kind of hesitant to chalk it up to rising odds of a Trump victory, given, it's still kind of a coin flip. And, it's mostly an economic data story.
Eric, I wanted to ask you about the rising odds of a Trump victory. There was a chart, Lori Calvasino over at RBC Capital Markets has been tracking this for a couple months now, just simply looking at the S&P 500 and the odds of a Trump win, right? I think there are a lot of factors, like you just said, that maybe go into that light blue line there, moving the S&P 500 higher. But some have tried to say, at least at net, the market has leaned toward pricing in a Trump win versus pricing in a Harris win. Do you think we're at that point yet? We're headed into next week. That feels like where the market's positioned, that it's positioned for a Trump win, and a Harris win would maybe prompt a surprise to the downside?
I don't think so. If you chart ice cream sales and crime, they look like they track as well. I think a Harris administration would be at least pretty similar to the Biden administration. It's, she's obviously the vice president. Her economic plans there's worries about a fiscal deficit, but, recent estimates obviously have Trump's plans being even more worrisome on the fiscal side. So I think the market would do fine with Harris. I think the market would do fine with Trump. I don't think the stock market would, is really pricing any presidential odds. If you think about earnings season, it's been going pretty well. Big banks did well in Q3. We should get above 3% year-over-year growth for the third quarter, which we get later this week. So yeah, I mean, things look good on the earnings side. Things look good in terms of economic growth. So it makes sense that the stock market, is kind of around record highs, especially given the Fed is easing into that really hot economy. So I don't think it has to do with the presidential election.
So Eric, let me ask you, so if the economy looks decent, earnings look decent, what worries you and Dr. Ed right now? When you get together, you discuss your wall of worry, what comes up?
Yeah, I mean, the biggest risk for us, at least in terms of domestic growth, has been geopolitics for a while. It's still just a 20% outlook in terms of our kind of probabilistic scenarios. But I mean, today, I think a lot of the enthusiasm for cyclicals had to do with Iran and Israel's tensions fizzling, or at least, Israel's attacks on Iran not hitting oil fields. Oil dropped, 5+%. Financials and materials both did very well. We also had some mix-up in the Japanese political scene, but it looks like, investors are kind of hoping the conservative parties figure out a way to. The conservative parties there are really in favor of easy monetary policy. So the Nikkei ran up, the yen weakened. I think broadly we're just seeing fewer risks to global growth, and the U.S. has been the strongest economy to date and for the past couple of years. So. I think there's a big risk that the next president or the next administration really continues to blow out the deficit. But the bond market's pricing that in. And, as the yield kind of fell towards 3.6%, we were saying, we don't think this lasts and it's time to short bonds. And I think, 4.25%, maybe even 4.5% makes sense given the economic fundamentals. So, yeah, I'd say fiscal concerns and the geopolitical landscape, but, so far, nothing too major, hence why we're at record highs.
Eric, I'm curious over the next week, we've talked about it a little bit here, plenty of headlines to look at, right? You could go big tech earnings, you could go all of the economic data we're getting this week, you have the election, you have the Fed meeting next week. What do you think is going to be driving markets here over the next week? Is it the fundamental story with earnings, or are we going to be a little bit more macro focused?
Yeah, I think earnings will probably be in the driver's seat. Barring anything unexpected. There will be more chatter about the election. But I think in terms of Q3 GDP, expecting really strong growth. If anything weird comes out there, we'll see what has to, we'll see what happens. We're expecting real incomes and real spending to rise about 0.5% month over month, which is really healthy and kind of tracks with that strong growth. We get the payrolls report on Friday. Monthly payrolls have been huge for the past several months and even year, but we're going to get this one muddled by worker strikes, Hurricane Milton. There have been some layoffs by Boeing and Stellantis in terms of the auto companies. So it's going to be hard to get too much of a read from there. You'll probably get a little uptick in the unemployment rate, slower payrolls growth, but we think the labor market still looks pretty good. I mean, the layoffs have been due to workers asking for exorbitant pay increases, not because of some broad cyclical slowdown. So, even if payroll growth subsides a bit in November, we expect it to, or subsides a bit in October, we expect it'll rebound through the end of the year.
Eric, how do you think the market would take a very weak print on Friday? There are some reports out there that this could really distort data, right? So at least the headline numbers do not look great. Do you think that's something that the market can accept?
Yeah, I know Bloomberg Economics is calling for a negative print. I mean, they've been wrong on the labor market for like 2 years, calling for a recession. So I don't know, maybe they're right this time. I don't think it'd be a huge deal. I think the Fed is uber committed to being dovish. So I think, based on some recent Fed speak, there's a chance that given the bulk of economic data we've seen, some of the more hawkish members get a little more sway at the upcoming meeting. I don't think a super weak payrolls report would be that concerning unless it looked like it was really cyclical sectors that were seeing layoffs. I don't expect that. The big risk, I guess, if there's a GOP sweep during the election, I think a sweep, and it's much more likely to be a GOP sweep than a Democratic sweep, gives you that kind of like rubber stamp approval, right? You can pass everything you want. But again, it's a really murky congressional makeup, right? Like not every Republican and not every Democrat votes really party line. So, I'm not really worried about this payroll report. We're watching it, but it's going to be weak. We'll be waiting for the next one. Continuing claims rising a little bit. Initial claims don't look too bad. So labor market looks okay.
Eric, great to have you on the show today. We had a lot in a short period of time there. Thank you.
Thanks, guys. Have a good one.
All right, Ford's third quarter results hitting the wire just now. Taking a look now at the numbers, you can see stocks down about 2-3% now. In terms of adjusted EPS, well, let's start with third quarter revenue, Schaefer. $46 billion, net income 0.9 billion. That includes a previously announced $1 billion EV-related charge. Ford Pro revenue increased 13%. It looks like Ford Pro Intelligence paid software subscriptions up 30%. To nearly 630,000 users. Full year 2024 adjusted EBIT now expected to be about 10 billion.
Yeah, and that full year 2024 adjusted EBIT now expected to be 10 billion. They had seen a range of 10 to 12 billion, Josh. The estimate was for that to come in between that range at 10.63 billion, so perhaps a little bit lower than the street expected there. Looks like that's the same for a couple of these EBITDA numbers. So Ford sees full year Ford Pro EBITDA coming in at $9 billion. That was supposed to be or they had previously seen a range of 9 to 10. So a couple profitability forecasts here coming in at, yes, it's within the range, but on the lower end of the range. That normally is not something that would at least maybe make the stock go up. So you're starting to see shares trade a little bit lower here, but maybe that's what's driving the move so far.
Yeah, CEO Jim Farley in a statement saying they're talking about how they're in a strong position with Ford Plus as our industry, he says, undergoes a sweeping transformation. He talks about making strategic decisions, taking tough actions, he says, to create advantages for Ford versus the competition in areas like Ford Pro, international operations, software, next-gen EVs. Stock, though, at least initially here, we're down the after hours, and of course, it was already firmly in the red year to date, Josh.
Yeah, shares continuing to fall right now. Of course, we have that call coming up in a little bit, so it'll be interesting to hear what CEO Jim Farley says about that guidance, perhaps maybe a little bit more clarity on what they're looking at into 2025. Sometimes that can ease the street as you get into that call as well.
All right, well, we're coming up. We're going to get some analyst reaction to the latest numbers from Ford. Stick around. More market domination overtime coming right up.
Ford trimming its profit forecast as it reports its third quarter results. For more, let's get to S&P Global Ratings Auto's Managing Director Nishit Medmani. Nishit, Ford shares trading a little bit lower after this report. Curious just broadly what you make of what Ford just told us about its quarter and what that's saying about the state of the business.
Yeah, first of all, thanks for having me. So from a credit ratings perspective, I mean, we currently have a stable outlook, and that hinges a lot on cost improvements that we were expecting over the next 12 to 18 months. We had lowered our margin forecast in the summer, so that narrowed the cushion for any significant underperformance. So the numbers that came in earlier today at the lower end of their range, it doesn't inspire too much confidence, but we had already baked that in our lowered forecasts. So that's the story relative to GM. Obviously, a weakness.
Do you see, obviously a big thing we talk a lot about is, EV sales growth, not what it used to be. How do you see the trajectory of EV sales broadly playing out over the next 6-12 months?
Yeah, we're expecting a slowdown, and that's consistent with what we've been hearing from multiple players in the industry. Short term, it's not too bad because that means they can sell more of their more profitable vehicles. But it does mean that there are costs that need to be spent because they have had changes in strategy as far as certain products that had to be rolled back. So those reimbursements to suppliers will have to be made. So it does raise those costs. And then longer term, it also introduces the possibility of more missteps because all automakers don't know which way to go in terms of propulsion systems because there are so many options available as far as the future is concerned. So it does add that uncertainty, and it reduces the timeline by which they can bridge the gap versus some of those Chinese automakers that are making rapid inroads.
You mentioned the shift to maybe scale back some of the EVs, right? We know Ford has been doing that really industry-wide. That has been the case. How long is that going to take for these companies to right-size some of the significant spending they were putting into EVs that they might not get back and sort of how that weighs on profitability? How long does that take to play out?
It's going to take a while. Look, I mean, they've already delayed some of the CapEx plans. I mean, Ford specifically has made changes. They've basically canceled the all-electric three-row SUV and want to only make a hybrid one now. So those changes we're going to probably see more of as and when we see customers, being slow to adopt EVs. Pricing is going to be a big factor. Next year, we're building in, fairly aggressive pricing assumptions. We think EV prices have to come down quite a bit to align with demand. And I would say at least over the next 2 years, that's going to be a big headline as far as, the timeline for achieving profitability in the e-business for all automakers. So pricing is going to be the biggest negative for them to get there.
Nishit, I'm curious, what's been working for Ford? Because if you look at this latest print, it sounds like you're kind of traditional gas guzzlers, Nishit. I mean, they talk about North America volume. They say that was up 8%. They call out that's newly launched trucks and SUVs.
Yeah, and that's not different from what we heard from GM. GM was able to hold pricing very strongly. We heard from them last week that relative to the industry, because of these new launches, they've been able to price well. For Ford, what's working is they have a high reliance on their commercial vehicle business. So that's their transit van, the Super Duty. That's their high margin business. And it's been pretty resilient because they have good market shares. They have pretty strong pent-up demand because of all the investment in infrastructure and utilities. Those are the fleet operators that are looking to refresh their vehicles. And it tends to be very high margin. So that's what's working in their favor. And so far this year, that's what's helped them sort of mask the inefficiencies in getting their costs down, because that's been a big negative.
Nishit, you brought up GM there, and I'm curious, thinking back to GM's report last week, we obviously saw the stock move higher on that. Seemed like they perhaps surpassed expectations. What is GM doing a little bit differently? Are they doing something differently, or is it just a matter of expectations being at a different place for the two companies?
Yeah, look, I'll say from a ratings perspective, again, very solid cushion. GM's rated one notch higher than Ford. They've had very consistent execution. So when they reported last week, their dealer inventory was down by almost 50% since the start of the year. And that's important because that reduces pressure on them to put discounts. And so that's going to help them manage pricing much better than Ford and Stellantis. And what they've also done better is they've been executing better on controlling their production costs. They've benefited from lesser configurations, fewer part numbers, and just having that control over their supply chain has been, somewhat of a benefit versus the others.
I'm curious, Nishit, just broadly for U.S.-based car makers, China, how big of an opportunity do you still consider that long term?
Yeah, I mean, look, it's a market where not just for the U.S. automakers, but even the premium German automakers, it's been a bloodbath as far as pricing pressure is concerned, as far as what that means for their future strategy is concerned. From our perspective, the question is, can the U.S. automakers ever get back to their historical levels of, cash contributions from that market? And the answer is no. We don't think they'll get there. So the question really is, to what extent can they mitigate some of the recent market share losses? Can they get close to break even and slightly profitable? And to what extent can they restructure that market to focus on more of an export focus? So that's going to be the area of focus from a credit rating standpoint. We don't see that market getting close to their historical levels for the U.S. automakers.
Nishit, appreciate your time, that instant analysis. Thank you so much.
Thanks for having me.
Time now for What to Watch Tuesday, October 29th. We are in the thick of earnings season. A lot of big names reporting tomorrow, including Alphabet, Visa, and AMD. Alphabet, the latest of the Magnificent Seven companies to report, is announcing results for the third quarter. Analysts expecting growth in Google Cloud and subscriptions to drive revenue in Q3. They'll also be listening for anything on AI spending, as any new commentary could impact AI juggernaut NVIDIA.
Moving over to jobs, the monthly JOLTS report, that's the Job Openings and Labor Turnover Survey, is coming out in the morning. Economists forecasting job openings tick down slightly to 8 million in September, giving us more insight into the labor force ahead of Friday's full jobs report.
And taking a look at the economy, we're going to be getting a new consumer confidence reading for October in the morning. That number expected to increase to 99.5. It's coming after what we saw last week, with consumer sentiment rising to a 6-month high of interest rate relief.
That'll do it for today's Market Domination Overtime, but be sure to come back tomorrow at 3 p.m. Eastern for all of your market coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack. Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains, where for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here's some of the trends we're going to be diving into. A strong start for markets this week. The Dow snapping a 5-day losing streak as oil prices tumble. Comes as investors gear up for one of the busiest weeks of this earnings season, with 5 of the Magnificent Seven set to report. We're going to be diving into the takeaways from the trading day. And it was a big day for Apple, a slew of new product announcements, plus the rollout of some Apple Intelligence features, what you need to know, and a look at whether this will be a driver for Apple's business going forward. And the rising cost of the Boeing strike, and it goes far beyond the jet maker. A new estimate showing the economy has taken a $9 billion hit so far. We've got the very latest details. Well, the AI spending boom will be a big focus when big tech companies report earnings later this week. Generative AI has unleashed one of the largest spending sprees in corporate history. Investors now asking when those bets are going to actually pay off. And Akiko Fujita joins us now with a look at where all of that money is going. Akiko.
Hey there, Josh. Yeah, the short answer is a big chunk of that money is going to data centers. Amazon's AWS, Google, Microsoft are all on pace to spend a combined $50 billion a quarter on capital expenditures. You factor in demand from all of the other players in AI, and that has led to a global land grab for real estate. Construction for data centers in the U.S. have increased 7-fold in just 2 years, according to data from real estate giant JLL. And we've seen particular growth in co-location data centers. These are centers that provide the power, cooling, and physical infrastructure for businesses. Capacity there has doubled since 2020, with Austin and San Antonio, Salt Lake City, and the Pacific Northwest seeing the biggest rate of growth for data centers. The problem is there just isn't enough supply to meet the demand. JLL reports vacancy rates are near zero, even with tech companies paying top dollars to rent prime space. And that's leading to some unusual arrangements. Here in LA, we've seen data centers filling at least one high-rise downtown that once used to house office workers. Office buildings struggling to fill vacancies are finding a match with tech companies nationwide. But that's also led to backlash, particularly because of the energy usage involved in housing these centers. In Atlanta last month, the city council approved an ordinance banning the construction of new data centers downtown after they witnessed a 76% jump in construction of those facilities. I spoke to Elizabeth Hart, who leads leasing for North America at Newmark. She said she expects the build-out to continue, with data center demand projected to double by 2030.
Anywhere that there's power is kind of the answer at the end of the day, right? But you're certainly seeing it in a variety of different markets across the U.S. You know, Phoenix is growing. You're considering to see growth in Ohio. New Albany would be another great market that's continuing to grow very rapidly. So when there is power availability, you know, that's when you're seeing the data centers come in. And in many cases, people are looking at data center strategies that could be, 10 to 12 years out, because you have to have the multiple timelines of, sometimes construction, time to power, making sure that you're able to get that. It's not always in a very short period of time. It can be up to a decade-ish to get what you want. And people are very patient about that, right? They want it now, but they also know that to build out a very sensible strategy, it may be a decade-long quest.
The optimism and promise around AI has also led to a surge in funding for private companies, with a lot of that funding coming from the hyperscalers. Venture capital investments in generative AI startups surged to $23.9 billion in the first half of this year, according to PitchBook data. That is on track to exceed the $26 billion in funding that was raised in all of 2023. PitchBook says investors are placing their bets, particularly in startup cloud providers, to supplement existing data centers, and they're investing in new AI chip startups as well. And while the focus is on data centers, Hart says the AI spending dollars are also being applied to traditional offices. She says these companies are more committed to bringing workers back to the office. That's leading to a big reset, with demand reaching pre-pandemic levels in some urban centers. Although, Josh, as you know, in some of these key areas like New York City and San Francisco, certainly that office demand, at least not anywhere near where pre-pandemic levels were.
For sure. Thank you, Kiko. Appreciate it. Well, it is a big week for Apple. The tech giant isn't just set to announce Q4 earnings on Halloween. It's also started rolling out the first of its Apple Intelligence features today, and announced a new iMac. Joining us now to discuss all this is Bob O'Donnell, Tech Analysis Research President and Chief Analyst. Bob, it is always good to see you. So want to start on news here of Apple pushing out these new AI features, Bob. And I was talking to Ben Beharin today, like yourself, smart guy, Bob, thinks a lot about Apple. And Ben was saying, really the onus here is going to be on Apple. And I asked him what he meant by that. And he said, Apple is going to have to simply convince users around the world that these new AI features, that they're that useful, that important, that powerful, that they really do improve the user experience that much. He said, listen, it's going to take a convincing, concerted, and smart marketing campaign here. You agree with that, Bob?
I do, and Ben and I have actually talked about this quite a bit. I mean, here's the deal. As of today, it's Apple semi-intelligence, because we're not quite totally there yet, right? They introduced a number of capabilities, text writing, a couple of other fun little things, Genmoji. Of course, you have to sign up for all these things before they show up. But, look, Apple is facing some of the same issues that the entire industry is facing, which is convincing consumers that this AI stuff matters. I think the story on the business side is a lot more clear, that Gen AI can actually help people be more productive, get more things done. For consumers, which is of course where Apple's primarily playing here, it's a bit tougher. I mean, there's some image editing things, but of course Google's done some of that before, and text creation, auto replies. We've seen that. This is a slightly more advanced version. So I think Ben's right, and I think you're right, that Apple's going to have to really convince consumers that there is value in this capability, and it's going to take a long time. Let's be honest. It's not something that's going to happen overnight, and we saw that already in the enterprise world. It's taking a few months to play itself out, actually a few years it's going to be. Same is going to be true here for the consumer side. So I don't expect a big impact right away, but longer term, it's just going to embed itself into how you use your device, and eventually, it'll be a completely different experience. I think it'll kind of sneak up on us, but right out of the gate, we're only halfway there.
Do you think, though, Bob, I mean, and again, this isn't to your point, it's not a near to intermediate question, but I am curious whether long term, do you think of Apple as maybe beyond the most of any of the Mag 7 names, if they stick the landing, has the most potential to be where the most people actually experience the kind of Gen AI benefits we talk so much about?
Well, it's a good question, Josh. I mean, I do think actually for the next several years, there's more opportunity from a business perspective in enterprise. By business, I mean actually in the amount of revenue that could be created. So I think it's going to take longer for consumers to generate the revenues for these additional services. Now, look, Apple has made an unbelievable business of their services. Eventually, I imagine we will see a for-fee version of Apple Intelligence that they charge extra for, and that's where they're going to generate these additional revenues. And at that point, which is several years out, I think, then yes, I think Apple will really benefit. But in the meantime, I think it's going to be the enterprise-focused companies that are going to see the biggest benefit from Gen AI. And Apple will be sort of, a little bit slower in that regard.
Beyond Apple, of course, not just Apple, right? We got a number of Mag 7 names reporting this week, Bob. The mega AI trend, I want to get your thoughts here. When these companies report, do you expect them to keep saying, yes, we are going to keep spending on AI? Despite the fact that last earnings season, Bob, I mean, we talked about this, you did hear some rumblings. I wouldn't even go as much to call it pushback, but some, at least investors raising questions about, okay, you're spending. Where is the actual return?
Yeah, no, look, it's a great question, Josh, but I literally just published a study 2 weeks ago looking at this. I surveyed over 1,000 US companies, and the truth of the matter is we're really at only the beginnings of these companies starting to do their own AI stuff. So as Akiko was talking about, you've got these co-location centers like the Equinixes of the world, where a lot of businesses are starting to deploy their own AI workloads. And up till now, most of the growth has been AI in the cloud. So it's been the Metas and the Microsofts and those types of companies, Amazons. They will continue to grow, but the opportunity, I think, is actually going to be in how companies, regular businesses, start to run Gen AI workloads either in a co-location facility or back into their own data centers. And that's where there's a lot of opportunity. 80% of the people I surveyed said they were interested in running Gen AI on-prem, but less than 10 are currently doing it. So that's a big opportunity.
Of the Mag 7 names, Bob, I'm curious though, are there certain names that you think have so far been able to leverage AI more effectively than others?
I mean, sure, I guess some of the cloud guys I would argue have. Certainly, I think Google has. I think Meta certainly has as well. But, I'm thinking, longer term, we're going to see opportunities. NVIDIA has obviously owned the semi side, but AMD's got a very strong play here. I think we'll continue to see strength from AMD, and of course, they're reporting this week. But I think you're going to see the cloud guys, the Microsofts, the Amazons, the Metas, the Google/Alphabets. They will continue to be the big players, and they're going to be the ones who are going to benefit the most in the near term.
Bob, always great to see you and have you on the show. Thanks for joining us.
Thanks, Josh.
Well, U.S. stocks closing higher to start the week with the Dow leading the pack. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
All about bonds today. Forget the Dow for now. Rates are at the Rubicon. What do I mean by that? I'm talking about the 10-year T-note yield, which just hit 4.3% earlier today, settled at 4.28%. But I just want to show you what has happened over the last month. Josh, it's no surprise you've been tracking this as well. Bond yields have been heading higher. Now, I want to point something out. This is what Goldman Sachs wrote a few days ago. This is pointed out by the Marketeer. The impact of higher interest rates on equities becomes noticeable after a sharp rise in yields. Historically, a 2 standard deviation move in the U.S. 10-year yield, this is about 60 basis points, signals when stocks start feeling pressure. And guess where we are? We've seen about that move this month, and so this is where we might expect to see a little bit of a head fake from equities.
And what if play this out. What if rates just back off from here?
Well, that's actually probably a good thing because that relieves some of the pressure valve. Let me just show you a 2-year chart. This goes back 2 years. This is the highest that the 10-year has been since the pandemic, and it is now screamed higher basically into this trend line. And while Goldman Sachs is looking at 4.3, I'm looking as high as 4.35%. I don't think we've seen the exact last of this move, but if we head to say 4.4%, that's when I think we start seeing some real trouble in equities.
All right, Jared, point number 2.
Yes, let's get to that. And, ooh, drums here. All right, cyclicals to lead. And so this is bringing up the sector rotation that we've been looking at. Bank of America just out with a great analysis, Savita Subramanian there. She's saying that we should think about cyclicals potentially leading, and here's some of the evidence here. Cyclical companies are still citing sluggish demand, and she's going over all the transcripts, and they actually parse these with a NLP processor there, and she's saying historically a jump in bottom, and that's the bottom being mentioned in earnings calls, has often marked an inflection point in EPS, that's earnings per share. So the bottom might be here, and she points to the fact that we are in an ongoing destocking cycle, the beginning of an easing cycle, and plus we have an election on the horizon. So there's a lot of uncertainty here.
I meant to ask you, how does the election as another variable factor in?
You know, the election is really interesting. It pulls forward certain things, but we've been talking about after the election, we're going to see all this pent up demand. Well, it seems there's even more. And while you might be concerned, we've pulled some of that demand forward with all bucking the seasonality. Remember, stocks were supposed to be down in September, October, didn't happen. I'm still looking as quite a potential there for cyclicals, for an everything rally after the election. Doesn't have to happen, but remember, we saw that 4 years ago and then 4 years before that.
All right. Final point, Jared.
We got to end on Bitcoin. Bitcoin knocking on 70,000 one more time. And let's just go to the charts because we've seen this play out before. 70,000 is a big psychological level, but it's not even the record high. And let's see, there we go. There's Bitcoin. And this is a 2-year chart. This will do. You can see we've just been consolidating near these recent highs. When we broke out of this negative trend channel, that was kind of something to get a little bit excited about. But I said it doesn't matter until we clear and we're at record highs again. Clearly hasn't happened just yet.
Didn't you tell us, my friend, a few weeks ago, wasn't MicroStrategy? You said, watch MicroStrategy, that's the tell.
I'll tell you what has MicroStrategy been doing? I just happen to have this chart right here. Over the last 3 months, it has been skyrocketing higher, particularly over the last month, basically since October. It has led the way higher for Bitcoin before, and it might be doing it again. We have to see if Bitcoin follows.
All right, we shall. Jared, thank you, my friend.
You got it. Oh,
appreciate
thank you.
Oh, yeah. Stick around. We're asking for a trend right on the other side. Boeing launching a nearly $19 $15 billion share sale to address liquidity needs. The jet maker looking to dig itself out of the trouble after grappling with manufacturing issues as well as an ongoing strike that is turning out to have a costly economic impact. A new estimate from the Anderson Economic Group says the machinist strike has already cost more than $9.5 billion. And joining me now is Anderson Economic Group CEO and Principal Patrick Anderson. Patrick, it's good to see you. So you say the ongoing strike against Boeing, combined losses, we're now nearly at almost $10 billion here. How did you arrive at that figure, Patrick? Walk me through the methodology.
We've been doing these estimates for loss events like strikes and also positive events like big investments for over 20 years. We start off with the new wages. We include the losses to suppliers. We look at the losses that customers have, if any, and we tote it up using a very rigorous methodology that allows us to compare over time. We also go back and look backwards like we did previous strikes to see if anything happened in the real economy that allows us to calibrate it. So we're quite confident in the methodology, and at this point, we're looking at about $10 billion because we're a couple days past last February, and it makes it the most costly strike yet in 2024.
Let me ask you, I'm also curious, Patrick, what you didn't include in the methodology. I mean, were there certain variables that, wouldn't be included? Is it like unemployment benefits, for example?
But we don't include either unemployment taxes or unemployment benefits, either strike pay assessments or strike pay, because we don't want to double count something. We also don't include any reputational damages, and we're careful about what we count as losses to the company because, of course, strikes mean that the companies stop paying wages, so they save some money there. Then they lose a lot of money in terms of their production. So in this particular case, you see Boeing losing quite a bit. The biggest single chunk here is lost earnings for Boeing, which we're estimating at $5.5 billion. That's lost earnings flowing through to their shareholders, and that $5.5 billion is the main reason why they're out there looking for $19 more billion, because they need the capital in order to operate their company with this strike continuing now into the 7th week.
And I guess, it's interesting when you think about this, Patrick, a lot of folks might think, well, the impact must be, really in the Pacific Northwest. And I guess what you're implying here is when you really take into account the full range of variables and dynamics, it's broader than that.
It is heavily concentrated in the Seattle area, much more so than, say, the port workers strike that was spread across the East Coast and Gulf Coast, and even more concentrated than the UAW strike last year against General Motors, Chrysler, and Ford, which was spread among many auto states. However, it does extend all across the country. Boeing is arguably the biggest exporter from the United States of America. It has thousands and thousands of suppliers. Those suppliers are losing a lot of money now. They tend to be much, much smaller than Boeing, don't have the same equity. They can't go out to the capital markets the way Boeing can. So it is spread across much of the country, but still pretty concentrated in and around Seattle.
And Patrick, final question. We talk about these combined losses, and you hinted at this, but just double tap on it for us. Can you just kind of compare and contrast that with other strikes we've seen in the past?
Yeah, if we look at 2024, the strike against UPS would have been the biggest in terms of the number of workers that was averted. The port workers strike had almost no effect on the U.S. economy. It only lasted 3 days. And I think there was a lot of exaggeration of what it would have done. We looked at that kind of strike before, and it has an effect, but much smaller than this. The biggest strike of this type that we're looking at was the UAW strike against GM, Ford, and Stellantis, all three of them that went on for 7 weeks. That's the only one recently that's been any bigger than the Boeing strike, and we're closing in on it now with this strike by today probably at $10 billion.
Patrick, thank you so much for helping us think through this issue and now contextualizing it as well. Appreciate it.
Good to talk with you.
And coming up, I'm going to get you caught up on a few tickers that are moving after hours. Stick around. We're asking for a trend right on the other side. As we close in on the election, we're taking a closer look at Donald Trump's betting odds to win in our chart of the day. Yahoo Finance's Josh Schaefer joins me now with a closer look. Josh.
Hey, Josh, yeah, so there's been a lot of talk about a Trump win being, quote, priced into the market. So this is what we're looking at here as far as betting market odds go. You can see the betting market has ticked up pretty significantly to price in a Trump win. Now, the question is whether or not that is priced in to the stock market. So when we add our second line here with the S&P 500, you can see that the blue line, the light blue line, has been ticking up pretty similarly to the Trump betting odds. Now, the real question here is whether or not there's an actual takeaway from this chart. Is this market celebrating that former President Trump might win the election and markets rallying on that? Or are markets rallying on, say, earnings, better than expected economic data, other things that typically move stock prices? We spoke with Eric Wallerstein, the chief market strategist at Yardeni Research, earlier this afternoon, and he seemed to argue more with the latter of that case. Let's take a listen.
You know, if you chart ice cream sales and crime, they look like they track as well. I think a Harris administration would be at least, pretty similar to the Biden administration. It's, she's obviously the vice president. Her economic plans there's worries about a fiscal deficit, but, recent estimates obviously have Trump's plans being even more worrisome on the fiscal side. So I think the market would do fine with Harris. I think the market would do fine with Trump. I don't think the stock market would, is really pricing any presidential odds.
So Wallerstein weighing out the case there that the stock market hasn't really priced in either presidential candidate winning, in sense inferencing that if we get to next Tuesday and no matter who wins, it's hard to tell whether that's going to be a clear buy or sell sign for stock investors. And I think that's perhaps the key takeaway from this Trump trade being priced in narrative, Josh, we've been talking about a lot, is there are a lot of things that can move markets, right? You've heard the Trump trade being priced into the bond market. Well, there's a million reasons someone could tell us why the 10-year yield has moved up about 60 basis points in the last month. Perhaps pricing in the odds of former President Donald Trump could be part of that, but it's not the whole story, and it's definitely not the whole story when it comes to the S&P 500.
All right, thank you, Joshua. Now let's take a look at what's trending here after hours. Shares of VF Corp surging. The North Face and Vans owner beating earnings estimates for the second quarter. Company reporting adjusted EPS from continuing operations at 60 cents. That's versus estimates of 38 cents. Revenue also coming in better than expected. CEO and President Bracken Darrell saying that on the call that Q2 reflects a broad-based improvement in year-on-year trends. Meanwhile, our next mover, F5, that stock getting a nice boost after being on both revenue and earnings, with its board of directors also authorizing a $1 billion share buyback program. Cloud cybersecurity company says it expects revenue in the range of $705 million to $725 million for Q1 2025. And make sure to tune in to Market Domination tomorrow. We're going to be speaking to F5 CEO Francois Locoh-Donou. And finally, shares of Amcor are sinking. The chip packaging and test services provider reporting third quarter earnings of $122.6 million and also missing estimates for its fourth quarter EPS forecast. The company says it sees EPS in the range of 28 and 44 cents. Analyst estimates have been 56 cents. Well, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.